Listen, if you're putting your money into Nvidia, AMD, or chip makers thinking you've cracked the AI investment code, I need you to stop right there. What I'm about to reveal is going to completely change how you think about profiting from the artificial intelligence revolution. This could be the difference between modest gains and life-changing wealth over the next 2 years. The real AI gold rush isn't happening where everyone's looking. While millions of investors are throwing money at the obvious plays, there's a massive bottleneck forming right now that's creating an incredible opportunity. And most people have no idea it even exists. Welcome to Stock Vibe, where we cut through the noise and show you where the real money is hiding. I'm about to break down 7 companies that could absolutely explode in value, and I guarantee at least 5 of them aren't even on your radar yet. Before we dive in, if you're serious about building real wealth and you don't want to miss opportunities like this, hit that subscribe button right now. The insights we share on this channel could be worth thousands, if not millions, to your portfolio. Smash that like button because it helps us reach more people who need to hear this message. What do you think is the biggest challenge facing AI companies right now? Is it building better models? Is it getting more advanced chips? If you guessed any of those, you're thinking like 99% of investors out there, and that's exactly why you're leaving money on the table. The real answer is power, electricity, raw energy. And this isn't some future problem we might face down the road. This is happening right now, today. Tech giants like Meta and Microsoft just reported their earnings, and you know what they said? They have massive demand for their AI products, customers are lined up, money is ready to be made. But here's the kicker. They can't scale fast enough because they don't have enough power to run their data centers. Think about that for a second. These are trillion-dollar companies with virtually unlimited resources, and they're being held back by something as fundamental as electricity. That's not a small problem. That's a trillion-dollar bottleneck. Here's where it gets really interesting for us as investors. Building power infrastructure isn't something you can just throw money at and solve overnight. We're talking about multi-year lead times, permits, grid connections, transformers, substations. This stuff takes years to build. But AI data centers need power right now, like yesterday. So what happens when demand massively outstrips supply? Prices go up, and the companies that were smart enough to secure power capacity early are sitting on absolute gold mines. This is the investment thesis that's been quietly circulating among smart money, and it's called follow the watts. Instead of chasing the latest AI model or betting on which chipmaker is going to win, you follow the power. You invest in the infrastructure that makes everything else possible. There's an incredibly detailed research paper on this exact strategy published on a website called followthewatts.com, and I've spent hours going through every single detail. What they've identified is a group of 7 companies that have already secured the power infrastructure that AI companies desperately need. These aren't speculative plays. These are companies with signed multi-billion-dollar contracts with the biggest players in tech. Let me break down these 7 opportunities for you, and I want you to pay close attention because this information could seriously change your financial future. If you're finding value in this, drop a comment below and let me know which of these stocks you're most interested in. The first company on this list is Applied Digital, ticker symbol APLD. This company owns massive data center campuses. And here's the crucial part. They've already secured the power for these facilities. We're not talking about hopes and dreams here. They have multi-billion-dollar contracts with hyperscalers like Amazon Web Services, Microsoft Azure, and Google Cloud. The beautiful thing about Applied Digital is that their infrastructure would take competitors years to replicate. You can't just build this overnight. The power is secured, the facilities are being built, and the contracts are signed. Next up, we have Galaxy Digital Infrastructure, ticker GLXY. This one's really interesting because they have huge grid-connected capacity in Texas. Why Texas? Because Texas has its own power grid, which actually makes certain regulatory processes faster. Galaxy has deals with major cloud and compute partners, and their expansion runway is massive. Number 3 is Cipher Mining, ticker CIFR. What I love about Cipher is that they have what's called multi-hyperscaler optionality. That means they're not dependent on just one big customer. They've got relationships with multiple major players, which reduces risk significantly. They're combining compute demand with power-secured growth before the broader market has really caught on. The fourth opportunity is TeraWulf, ticker WULF. This one's particularly exciting because Google is a strategic equity partner. Let me repeat that. Google has taken an equity stake in this company. When one of the biggest tech companies in the world puts their money directly into your business, that tells you something. TeraWulf is rapidly transforming and moving their power to compute pipeline forward at an impressive pace. Number 5 is Riot Platforms, ticker Riot. Riot has a massive footprint in Texas, and they just landed their first contract with AMD. This was added to the follow the watts thesis, specifically because of their grid position and their execution capability. They're showing they can deliver, and in this game, execution is everything. Now, there are two adjacent plays that are also worth your attention. The first is Iris Energy, ticker IREN. Iris has a huge power portfolio, but they're monetizing it through GPU cloud leasing rather than pure infrastructure plays. It's a slightly different angle on the same thesis, but still very compelling. The seventh and final company is Nebius Group, ticker NBIS. Nebius already has strong revenue and they're scaling rapidly with hyperscaler GPU compute contracts. This one's been getting a lot of attention lately, but for good reason. The fundamentals are solid. Here's what's absolutely mind-blowing. According to the Follow the Watts research, these 7 companies together hold somewhere between $80 and $85 billion in contracted infrastructure revenue. Let me say that again, $80 to $85 billion in already contracted revenue. This isn't speculative. This isn't based on what might happen. These are signed deals with real customers. What makes these companies different from just buying Nvidia or Microsoft and calling it your AI play? Most AI stocks are valued based on growth narratives and future potential. Don't get me wrong, there's money to be made there, but it's also expensive and incredibly volatile. The infrastructure thesis is different. This is about real contracted revenue from the biggest tech companies in the world. This is about power infrastructure that literally cannot be replaced quickly. We're talking about tangible economic moats, not software that could be disrupted next month, not chips that could be leapfrogged by the next generation, but actual physical infrastructure that took years to build and would take years for anyone else to replicate. The bottleneck is real, and it's only getting worse. Every single tech giant is racing to build more AI capability. Every startup that gets funded is trying to train larger models. Every enterprise is looking to implement AI solutions. And all of it requires massive amounts of power. The gap between demand and supply isn't closing, it's widening. Now I need to be straight with you about the risks, because I'm not here to sell you a fairy tale. I'm here to give you the full picture so you can make informed decisions. First, there's execution risk. Building and delivering power infrastructure on schedule is incredibly difficult. Delays happen, cost overruns happen. We need to watch these companies closely to make sure they're actually delivering what they promised. Second, there's counterparty risk. These contracts depend on big companies keeping their commitments. Now, the likelihood of Microsoft or Google just walking away from a signed contract is pretty low, but it's something to be aware of. Third, the market might stay irrational longer than we expect. Even if the fundamentals are screaming that these stocks are undervalued, the market might not recognize it for months or even a year or two. You need to have the patience to hold through that. Fourth, technology could shift. What if future AI models become dramatically more power efficient? What if some breakthrough happens that reduces the power requirements per unit of compute? It's not likely based on what we're seeing, but it's theoretically possible. And fifth, regulatory and grid delays could slow everything down. Local approvals, environmental reviews, grid connection queues, all of this can add months or years to timelines. Does any of this mean you should avoid these opportunities? Absolutely not. But it does mean you need to be smart about how you allocate your capital. Here's what I personally do. This is not financial advice, I'm just sharing my approach. The vast majority of my portfolio, we're talking 80 to 90%, goes into solid broad-based ETFs, index funds, the boring stuff that compounds steadily over time. But that remaining 10 to 20%, that's where I take calculated risks on opportunities exactly like this, high potential plays that could deliver outsized returns. Because here's the thing, if even 2 or 3 of these 7 companies deliver on their potential, the returns could be absolutely massive. And because I'm only risking a small portion of my portfolio, even if I'm wrong, it doesn't destroy my financial future. So how should you actually use this information? First, treat this thesis as one input among many. Do your own research. Read the earnings reports. Look at the actual contracts these companies have signed. Compare these infrastructure plays to pure hardware stocks and see which risk-reward profile makes more sense for your situation. Second, track the milestones. Watch for announcements about power interconnections, grid queue times, contract signings, facility completions. These are the events that will drive stock prices. Third, balance your risk. Don't go all in on speculative infrastructure plays and ignore the rest of your portfolio. Build a solid foundation first, then add these higher risk, higher reward opportunities on top. This thesis gives you a completely different framework for thinking about AI investing. Instead of trying to guess which software company will build the best model or which chip maker will have the fastest processors, you're investing in the actual physical layer that enables all of that computation to happen, something that can't be easily disrupted or replicated. Let me wrap this up with the key takeaways you need to remember. AI infrastructure is power constrained, and that constraint is real and growing. Companies that secured power capacity early and landed contracts with hyperscalers are in an incredibly strong position. The Follow the Watts thesis focuses on real revenue and real moats, not just hype and speculation. But execution matters, macro conditions matter. You need to stay informed and be ready to adjust. as new information comes in. This isn't a set it and forget it situation. This is an active investment thesis that requires attention. The opportunity here is massive, but it's not going to last forever. As more investors wake up to this bottleneck, as more research gets published, as these companies start reporting stronger earnings, the prices will adjust. The time to position yourself is before everyone else figures it out. So here's what I want you to do right now. First, if you haven't already, subscribe to Stock Vibe. We're constantly researching opportunities like this and sharing them with our community. Second, smash that like button and drop a comment below. Tell me which of these 7 stocks you find most interesting and why. Let's get a discussion going. And third, share this video with anyone you know who's serious about investing. The more people we can educate about real opportunities, the stronger our community becomes. Remember, the biggest wins in investing don't come from following the crowd. They come from seeing what others miss. They come from understanding the fundamental drivers of value before the market catches on. And right now, while everyone's obsessed with the latest AI model or chip announcement, there's a massive infrastructure play unfolding that could create generational wealth for those who position themselves correctly. The power bottleneck is real. The contracts are signed. The opportunity is here. The only question is whether you're going to take advantage of it. Thanks for watching Stock Vibe, and I'll see you in the next one.